Hello everybody, PT Research coming at you again with a new lesson. This is a big one, folks. PE is BS, okay? And you'll understand why the subtitle of this presentation is Operating Models Will Make You Rich by the end of this presentation. Now this is a bold statement, so it would seem. PE is BS. PE is perhaps the most used metric for valuation amongst Wall Street and Main Street investors. But in my estimation, it is also the most useless, because if you're looking to make the big money, you need to find companies that are about to explode, not the ones that are fully mature. Okay? If you buy companies that are fully mature, that everybody knows about, and it's based on the PE ratio, you're basically dealing with your typical stock. Your IBMs, your Microsofts, your GMs, your GEs, your Johnson & Johnsons. And if you buy those stocks, if you buy those typical stocks, you're going to make typical returns. The average stock will give you average returns. If you buy what everybody else buys, you're going to make what everybody else makes. And if everybody makes 7% a year, which is the average for the stock market, that's what you're going to make. Okay? So you're going to soon see why PE is the BS that keeps people making average returns. This will help you going forward, because when you see on the chat boards or in an article or what have you, somebody saying the PE is too high, the PE is too high, you'll know better, because PE is BS. Let's check it out. Alright, so I've preloaded a very basic operating model. If you're a finance major, or if you've graduated with a finance degree, or if you're an MBA, this may come across as very simplistic. Hang with me through this. For everybody else, it was made this way so that everybody can understand. Alright? So, in virtually any company that you could start, there's a number of things that are pretty consistent across most companies. First, most obviously, is revenue. If you have no revenue, you have no business, of course. Now, within that revenue, the things you produce will cost you money. Okay? And that breaks down into two types of costs. Fixed costs, the costs that are going to be there year in and year out, no matter whether you make no money or a ton of money. And variable costs, which are going to be predicated on how much money you make. So this number is going to stay the same every year, year after year. And this number is going to change based on how much revenue you're pulling in. Okay? Think about if you made a deal with somebody, like a salesperson, for example, and you say, hey, listen, I want you to sell my product, and I'm going to give you $100,000 a year. But I'm also going to give you a 20% cut on anything you sell. The $100,000 a year that you give that salesperson is your fixed cost, and the 20% commission that you give that salesperson is a variable cost. So let's do an example here. Let's say we have a company with $100 million in revenue in 2013. Let's say they're growing 30% a year. Okay? And that they have a fixed cost base of $100 million per year. Alright? We're going to say that they have a variable cost of 30%. And you'll notice that the spreadsheet fills everything else in. Alright? I've put formulas in here. So the variable cost, you can see this formula. Once I plugged in the variable cost percentage of 30%, it figured out to take B2, the revenue, multiplied by B6, the variable cost, and it will always calculate the variable cost for us. 30% of 100 is 30. Simple, right? Total cost, another formula, B4 plus B5, fixed cost plus variable cost equals total cost. Again, simple, okay? Profit, another formula, very simple, revenue minus total expenses, total costs, equals your profit. In this case, 100 minus 130 equals minus 30. This company didn't do so hot. Okay, they lost $30 million. And as a result, we're going to assume that they started the year with 0 in cash, and by the end of the year they have negative 30 in cash. Okay, and we might say that they've got some debt outstanding. Obviously, you can't run a business with negative 30. You probably have to borrow money somewhere. But right now they're 30 million in the hole. All right, valuation multiple. Well, the company is growing at 30% a year, so let's give them at least a 20 valuation multiple. And the valuation, well, if you have a profit of negative 30 and you give it a PE of 20, the valuation is negative 600, right? Of course, the stock's going to have a price associated with it. But it's not going to be a negative number. So this is where things start to get dicey with investors, okay? Because how do you value a company with no profits? Well, this is where the operating model comes in, and that's what we just built, a very simple operating model. The revenue, the different types of costs, and the resultant profit, okay? In a minute, we're going to stream this out into the future, and you're going to see something pretty magical happen, all right? Shares. In order to get the stock price, we need to figure out how many shares there are outstanding and divide it into the valuation. The valuation should always be based on some multiple of their profits, okay? And in fact, the real valuation metric is a discounted cash flow analysis. If you want to look that up, be my guest. It's an advanced topic. We won't be covering it here, and may not do so for quite some time. But the true value of a company is determined by a discounted cash flow analysis. Because it's so complex, Wall Street and Main Street has kind of dumbed things down to PE. And as you can see here, putting a 20 PE on a company that's losing money produces a negative number. So that's problem number one with a PE. Now, to get to the stock price, again, we do need the shares outstanding. Let me tell you right now, it doesn't really matter how many shares are outstanding. All that matters is the value of the entire company. If you buy a house, right, and the house is worth $1 million, it doesn't matter if you buy the house by yourself, 1 share, or with 10 people, 10 shares, or split it up amongst 100 people, 100 shares. Okay? The same thing goes with a company. A company is no different than a house. Each one is worth something, and in fact, both are worth the discounted cash flow that it's expected to generate over time. With a house, that cash flow is rent. And with a company, that cash flow is its profits. No different. It's just two entities that produce a certain amount of cash in exchange for an upfront investment. For a home, that investment is the price of the home. For a stock, a company, that is the price per share of the stock. And when you add up all the shares, you have the total value of the company. Okay? So the total value of this company, based on a PE multiple, we figured out to be negative 600. We can throw any number in here. I'm going to throw in 95. Okay? What's the stock worth? Well, a negative number, but there's no such thing as a negative number for a stock, so what do we value this thing at? I don't know. Maybe people will only be willing to pay 50 cents for this stock. All right? So, here comes the fun part. And you can already see the number starting to light up here. I'm going to unhide the next column. Boom. Okay? 2014 arrives. They have that 30% growth rate. So now they have 130 million in revenue, of course. Fixed costs, still 100. It's a fixed cost. Variable cost, 39 million, because 30% of 130 million in revenue is 39 million. Okay? Total cost, 139. The profit, oh, they still lost money. But look, they lost less than last year. So that's a nice direction, but they're still losing money. Okay, this is got to be a really bad company. These guys are losers. They can't make money. They can't make money. Okay, we keep the valuation multiple at 20, which means the company is now worth negative 180. Because hey, you know, PE is so great. You multiply the PE by the E, the profits, the earnings, and you get the P, the price of the stock. Oh, but that doesn't show up here because negative 180 divided by 95 shares is a negative number, and we know a stock can't be worth a negative number. But hey, you know, if people were willing to pay 50 cents for the stock last year, losing 30 million, maybe they're willing to pay, who knows, 70 cents for the stock this year. Okay? And why? I don't know. It's a dog. This is a dog stock. This isn't worth 70 cents. They're going bankrupt. This company's terrible. This company's absolutely, whoa. What's happened here? 30% growth over 130 gave them 169. I'm not going to go through all the numbers. You can look at it. Okay? And see what happened here. Look at the magic. Because of the high profits they make on each additional dollar, this fixed cost base has less and less of an impact over time. And because of that, their total costs are not growing at 30% a year. But their revenues are. The revenues are outpacing the expenses to the extent to which all of a sudden they made a profit. And if you've ever noticed on the stock market, when a company becomes profitable, the stock magically goes through the roof. Why? Well, we now have E, right? The E in PE is now a positive number. And so since we have the P ratio of 20 to multiply by 18 million in profits, we can figure out, oh, lo and behold, this company is suddenly not worth a negative number anymore. It's worth a positive number. Okay? And by the way, you know, we have the cash being calculated here. They lost 30 the first year. They lost 9 the second year, and so that kind of accumulates. All right? And so I've been excluding that from the final valuation. All right? You take it out. You back it out. This valuation, you can see, actually, I failed to, let's do this, failed to include that in the plus the cash. There we go. I'm giving up the goods on the future here. All right, so we fixed that. So what we're doing in the valuation is adding back the cash, and if it's negative, then it gets subtracted out of the valuation. Okay, so you can see what we have here now is a stock that has a P ratio of 20 on 18 million of profits, approximately. There's some decimals here. Okay, so we back out the net cash of negative 21, and we get a valuation of 345 divided by 95 million shares outstanding, and boy, now we have a stock price. We have a positive number. A positive amount of earnings times a positive PE equals a positive number divided by a positive number of shares outstanding. We've got a stock price. But look what happened. This dog stock that everybody hated at 50 and 70 cents has gone to 360. Okay? So if you waited for the company to be profitable, you missed out on a 7-bagger in 2 years and a 5-bagger in just 1 year. Huh. Let's see what happens next. I'm sure you can guess. Okay? And I'll actually just load up the rest. As the company continues to grow at 30% a year, as that fixed cost base remains in place, as that variable cost grows at a slower rate, as those profits really start to rack up big time. Okay? Big time growth. I mean, these guys were losing $30 million on $100 million in revenue. That looked awful. And now they're generating $100 million in profit on 286 in revenue. It's a 40% profit margin. It's huge. This must be one heck of a company. Maybe that $100 million fixed cost included the cost of getting some protection on their business that allows them to have these really high profit margins. Who knows, right? If you didn't research it, then you don't know. And then you couldn't build this model here to figure out that this company is going to make a lot of money in the future. Go back and look at the earnings reports for companies like Facebook or Salesforce.com back before they were public. And you're going to see these massive losses that have eventually turned into massive profits. Okay? And so if we take this formula here, let's see what our stock has done. Valuation. Boom. Wow. Okay? It tripled, and then it doubled again. Our piece of crap stock at 50 and 70 cents is a loser stock because they had no earnings. It was only a $3 stock because we used a PE ratio, right? And if indeed the stock was at, let's say, $4, and you did this math but didn't take your model out into the future, you would have said this stock's overvalued at $4, right? I mean, look, if we give this thing a PE of 30, right? If the stock's at 550, people might be going, PE of 30, that's expensive. That's too expensive for this stock, right? And you don't buy it. What happens the next year? At a PE of 20, the stock's at 1160. I don't know about you, but I'd be quite happy to buy a stock here with a 30 PE at 550 if I knew that the following year it was going to double to 1167. That's a cheap stock. Okay? So I think the point's made. All right? This is why PE is BS, because you have to understand the operating model of the business and what that could eventually lead to. Now, of course, this is a simplistic example, and what usually ends up happening is that there's some sort of limit to how much of a profit margin can be generated. In this case here, if we calculate it out, here were the profit margins, okay? And eventually they generated 35% profit margins. That's like, companies like Oracle, or maybe a biotech company who's really kind of hit it big on a drug that nobody else can sell but them. They have a monopoly. It's kind of monopoly type numbers. But the example is a good one, okay? It holds true, right? It may not be so dramatic down here for every company, but it can be for some. And this is the kind of research we do. This is why our picks end up tripling so often, because we figure out early on what they're capable of doing in the future. And then when the Wall Street estimates start to reflect that future, right, the stock price goes for a ride. Why do you want to wait until Wall Street lets us know that there's going to be big profits coming in 2016, right? By that time, everybody loves the stock. They're jumping in the stock. Certainly by 2017, everybody's all over this stock. And the big profits are already starting to go away, right? You see, this went from a 5-bagger to a 3-bagger to a 2-bagger. This isn't going to double again the following year. I'll bet you if we streamed this out, this number doesn't double. And it's an extreme example, right? The typical examples, once everybody loves the stock, that's it. There's a 50-50 chance that that stock will outperform the market, because if everybody loves it, who's left to buy it? Nobody. You want to buy the stock here when everybody thinks it's a dog, when nobody can calculate the PE and they don't know why. They don't understand. All right? So, let's take a real-world example. Glue Mobile. Okay? Here's a company that was losing money when I selected it as a Poised to Triple pick. And people were talking about their inability to make a consistent profit. Well, I don't know, call me crazy, but it looks to me like, by the way, here are the year ago numbers. See? Losses. Losses, losses, losses. This is what people are harping on. But it looks to me like these analyst expectations for September and December and the full year and next year are all positive. Huh. Looks like that bear argument's out the window, right? But let's take it a step further. Let's take a look at what we have here. We had a company that is going to make $230 million this year. They're going to make more than that, by the way, in my opinion. These guys haven't missed a quarter since 2008. The guidance they give is the guidance they hit for the past 6 years. And the last time they missed by $100,000. All right? They do this on purpose. It's easy. They have a good idea based on their analytics, based on their monetization engine, based on everything that they know about this business, because they've been in business a long time, how much money they're going to probably make this next quarter, and then they take that number and they chop it. And that's the number that they give us. And it makes it easier for them to make their numbers. Any smart company does that because they know the game. Okay? So, in any case, $230 million, let's stick with that. That's going to be 100% growth versus last year. It's going to be extraordinary because of the Kim Kardashian game, and as a result, next year, Wall Street's only expecting them to grow 11%. That's all well and good, but we need to smooth this out, okay? Because this company's been growing for several years. If you look at the income statement, all right, they had a rough year last year because they were in transition, because they were building that monetization platform. But prior to that, right, 2012 was very nice growth over 2011. And if we go back to 10, 9, and 8, you can look it all up in the SEC documents. This company's been growing very fast for a very long time, and we're back on track. Went from 74 to 108 to a year of investment at 105, and we're going to be doing 2-something this year, 230. All right? Not a bad rebound off of this number here. If they continued to grow at 33%, this would be 133. This would be something on the order of 175. It's going to be 230 instead. The 175 would grow another 30%, and that would get us to like 225. Okay? And instead, they're going to be doing 260 according to Wall Street estimates. So this company has set a track record of growing at 33% a year. Not every year. Some years you got to make investments. Some years you have a hit like Kim Kardashian. But in general, they've been growing at about a 33% clip. And not surprisingly, that's roughly the growth rate of the market that they're in. The mobile gaming market is exploding at a clip of about 33% a year. Because of the proliferation of all of these devices, there's more smartphones in the world now, tablets, there's going to be glasses soon, there's going to be these devices in our cars, we're going to have watches, we're going to be playing games on everything. We've got 2 billion devices that can play games right now on iOS or Android. That number is going to double in the next 2 years to 4 billion, and I wouldn't be surprised if 2 years after that it's 6 billion. So this industry is going to continue to grow, and Glue's growth has kind of borne that out. So what does that mean for profits? Okay, should we put a PE on this 24 cents? Well, let's take a look. We'll zero these out. Okay, we can get rid of that for now. Now, go back to this, and 2015 is expected to be 260 million. 260. All right. Now we're going to skip right to the meat, this profit number. Okay, and the reason the profit number is big right now is because we have no expenses kicked in. All right. We're going to do something pretty special here. And let me just zero out this cash numbers. We're going to assume that they're going to have no cash in the balance sheet whatsoever. Okay? We're going to give them P multiple of 20. All right? I'm going to zero out the shares outstanding. Maybe we'll look that up at the end. And we're going to just cut to the chase on the profits. All right? How are we going to do that? Well, oddly enough, this right here is a presentation that the company gave back in 2012. Okay? These numbers don't stand now, by the way. Management won't stand by these numbers. They've pulled their guidance. There's a lot of moving parts, but it's just to give you an example. Right? At this point in time, in here, they provided a target operating model. Target operating model. This is the key. This company, its management team, knows the company better than anybody. It knows what its margins are, the amount of money it'll spend on R&D, the amount of money it needs to spend on sales and marketing, on G&A, which is a fairly fixed cost. You see how it drops in percentage over time. Okay? And as a result, what their operating margins end up being. Okay? Adjusted EBITDA is another profit measure. All right? So, as of 2012, they expected that they would have profit margins in the 20 to 26% range. All right? So we can go back and assume that their profit will someday be, because this is their target, about 20%. Okay? And they're growing at 33% a year. So here's what their revenue picture can look like over the next few years based on that continued growth, which we can feel pretty good about because they just acquire companies and make a ton of money off of them. You know, they acquired the company that ended up making Kim Kardashian for $25 million, and Kim Kardashian is going to be probably a $200 million franchise by the time we're done, and that doesn't include the additional games that they end up making. If they make a LeBron James game or a Miley Cyrus game, that's all the same basic game. It's the same software engine. They're just changing the names to generate more revenue. They're going to make far more than $200 million in revenue off of that. So, you know, the M&A engine there is great, and it's going to enable these guys to continue growing at a fast pace. And if they hit a 20% profit margin, then this number actually represents their profit potential. Okay? Basically, it means that at some point in the future, they're going to hit that potential, that 20% target. Okay? It's not going to be next year. Okay? But this is the potential. This is how much profit they would make at 20% profit margins. Maybe it's 2017. Wherever it is, right? That is when the company flatlines, right? Once they hit their profit target, then their profit will only increase at the same pace as their revenue. And at that point, that's when PE becomes a lot more relevant and usable. But by that time, we're not going to want to be involved in the stock anymore. Okay? But for now, let's take a look at what we get. All right? So if we base our valuation metrics on the company's profit potential, because eventually it's going to hit that number, and in the meantime it's going to keep growing. The company's going to keep growing, right? We can figure out what the company's stock potential is today based on its profit potential. If we put a 20 PE on that, we get a valuation of $1 billion, $1.04 billion. All right? How does that compare to where we are now? Well, that's easy to look up. Go into Yahoo, look at its market cap, $500 million. All right? This company is currently trading at a 50% discount to its profit potential. And at some point, it's going to reach that potential, maybe 2017. And when it does, the stock is going to be worth $1.8 billion, which is almost 4 times where it is right now. Okay? And this is why this is important. The reason why you want to know the potential is because if this revenue is growing at 33% a year, and the company is coming closer and closer to hitting that profit potential each year, then you've got 2 numbers that are growing. And so eventually, when it does hit that profit potential, the profit potential is no longer the potential anymore. It is the actual profit. So if we say that in 2017, with a PE multiple, Glue is going to be worth $1.8 billion. The stock right now is $5.29 at a $500 million market cap. At a market cap of $1.8 billion, the stock price is going to be about $19 to $20 a share in 2017. If you pay $20 a share in 2017, let's backtrack here. Let's say I want to make 50% on this stock every year until 2017. This is what it's worth right now. Okay? Based on the 2015 numbers, right? This is the forward numbers. This is what people look at, the forward estimates. Based on our forward estimates in 2017, this is what the stock will be worth. Actually, this will be what the stock will be worth in 2016. This is what the stock's worth now. If you want to make 50% a year. If you buy this stock right now at $9, you will make 50% a year. If they get a PE multiple of 20, assuming that they hit their profit potential. And this is how it's done. Okay? So we're getting this stock for $5.29, and if they can hit these profit margins in the future, as they had suggested in the past, then we're looking at a stock that could be $20 a few years down the road that we're only paying $5 for. And that's a lot more, obviously, than 50% profit. This scenario right here represents a 50% profit. And who knew back here when the stock was making no profit at all? Let's take a look here. Final item of this video. Back here, this was a 23-cent stock. No profits. Must be a junky company. They're going nowhere. Even here, still a $1 stock. Even as late as September of last year, it's only a $2 stock. And so it was easy to build one of these models, to see where the company was going, to understand their business and why they weren't growing in 2013, those investments they were making, and then see the early returns on those investments. Okay? I didn't even initiate coverage on this stock until after they announced the results of the tests they performed on their new monetization platform. When I heard the results of those tests, I was astounded. Okay? If you don't remember the story, they took a game they had already released, re-released it, and made 40% more the second time around. When have you ever heard of a piece of content, like a movie, being released in the theaters, making $100 million, and then they come back 6 months later, re-release the movie, and it makes $140 million? Doesn't happen. That's because there's a big difference between what these guys were doing before and what they're doing now. And this is why I picked the stock. We put together one of these models. We figured out where the stock could go. We figured out what that meant for what the stock should be worth. You see, about $9. The stock was at about $3. That sounds to me like a stock that's poised to triple. 3 times 3 is 9, right? That's all I have to say. Hope you understood. Hope you enjoyed. Hope you now know that PE is BS. And I hope you know that through thick and thin and ups and downs, PTT Research is here to teach you the lessons that made Peter Lynch rich and famous, and Warren Buffett a multi-billionaire, the richest man on earth. Stick with us and we'll stick with you and teach you more lessons to help you become a multi-millionaire. And who knows, one day maybe you too will be a billionaire like Buffett. Until then, this is Mark Gomes wishing you great prosperity. I'll talk to you next time.